Welcome back. This is day 3 of Technical Analysis 101, and today we move into an entirely new family of tools, volatility and trend strength. Over the last 2 sessions, we answered 2 very different questions. Day 1 asked which way price is headed, using the simple and exponential moving averages. Day 2 asked how fast price is moving and whether that speed is fading using RSI and MACD. Today we ask a third, independent question. How wide has price's range become? That's what volatility measures, not direction, not speed, but dispersion. We'll build 3 tools around that question. Bollinger Bands, which wrap a moving average in a band of standard deviation to visualize how tight or how wide price's range has gotten. The average directional index, or ADX, which measures how strong a trend is, regardless of whether it's up or down. And the commodity channel index, or CCI, which measures how far price has stretched from its own recent average. In our advanced module, we'll go further than a typical course, standardizing the Bollinger squeeze into a proper statistical z-score, deriving exactly what a CCI reading of plus or minus 100 implies under a normal distribution, building a full multi-indicator regime matrix, and bridging all 3 tools back to Stan Weinstein's stage analysis framework from day 1. Let's get started. Before we continue, the same important note from day 1 and day 2, because it applies to every session in this course. Dreamlit Equity Research and its instructors are not SEC-registered investment advisors, and nothing taught today constitutes investment, financial, or legal advice. Everything you're about to learn, Bollinger Bands, ADX, CCI, and the statistical extensions in the advanced module, is presented strictly for educational and skill-building purposes. Dreamlit Equity Research bears no responsibility for investment decisions, trading losses, or damages that result from how you apply these concepts in live markets. That application and that risk belongs entirely to you. If you decide to trade or invest using any tool from this course, please consult a SEC-registered investment advisor or conduct your own independent due diligence first. My role today is simply to build your understanding of how these indicators work and what they actually measure. With that said, let's get into the material. A quick reminder of where we sit in the 6-day arc, because volatility only makes sense in light of what came before it. Day 1, complete, gave you foundations and moving averages, the simple and exponential moving averages and basic trend concepts. Day 2, complete, gave you momentum oscillators 1, RSI, and MACD. Day 3, where we are right now, is volatility and trend strength, Bollinger Bands, ADX, and the commodity channel index. Day 4 moves into momentum oscillators 2, covering the Shan momentum oscillator, rate of change, Williams percent R, the stochastic momentum index, and the detrended price oscillator. Day 5 brings volume and adaptive trend tools, Chaikin money flow, elastic volume-weighted moving average, zero lag EMA, and parabolic SAR. And day 6 closes with a strategy and fundamental crossover, the Piotrowski F-score, combining signals across the whole course, and a capstone project. Notice the layering, trend, then momentum, then volatility, today's step, then a second momentum pass, then volume, then synthesis. You're now 3 steps into that ladder. Here's exactly what we're covering today in 5 blocks. First, a short recap of the 4 indicator families, and precisely why volatility answers a different question than trend or momentum. Second, we go deep on Bollinger Bands, formula, a fully handworked example, a real price chart, squeeze and expansion interpretation, use cases and honest limitations. Third, we do the same treatment for ADX and CCI together, trend strength and cyclical extremes, each with its own formula, worked example, use cases and limitations. Fourth, a strategy spotlight combining a Bollinger squeeze with rising ADX to confirm a volatility breakout before acting on it. And fifth, our advanced module, quantified volatility regimes, standardized squeeze statistics, a formal derivation for what CCI's thresholds actually mean, a multi-indicator regime matrix, and the bridge back to stage analysis. By the end of today, you'll be able to compute all 3 indicators by hand, read what each is telling you at a glance, and combine them into a single disciplined read on market conditions. Let's define volatility properly before we build a single indicator around it. Volatility measures how wide price's range has become, not direction, not speed, but dispersion. Here's the distinction that matters most. A quiet, narrow-range stock and a wildly swinging stock can share the exact same trend and the exact same momentum reading, and yet behave completely differently in practice. That's precisely why volatility deserves its own indicator family. Why does it matter? Low volatility, a tight, compressed range, often precedes a sharp breakout. The market is coiling before it moves. High volatility, wide swings, means your signals need more room to be valid. A stop or target size for a calm market will get run over in a wild one. Zoom out to the four families of technical indicators: trend, momentum, volatility, and volume. Trend occupied day 1, asking which way. Momentum occupied day 2, asking how fast. Volatility is today's subject, asking how wide. And volume, still ahead of us on day 5, asks how strong the participation behind a move actually is. Keeping these four questions distinct is what prevents indicator overload later in this course. Part 1 of today's session, Bollinger Bands. Think of them as a simple moving average wrapped in an envelope built from standard deviation, a direct, visual measure of how wide or narrow price's recent range has become. As price grows more volatile, the bands widen. As it calms down, they contract. That's the entire mechanism, and it's exactly what we're going to build from first principles over the next few slides. Here is the Bollinger Bands formula in full. The middle band equals the in-period simple moving average. The upper band equals that same SMA plus K times sigma. The lower band equals the SMA minus K times sigma. Sigma is the standard deviation of the last N closes. The industry standard is N equals 20, K equals 2. You'll see those two numbers, 20 and 2, referenced constantly in trading literature. For our hand-worked example today, we'll reuse day 1's 5-day SMA as the middle band, with K still equal to 2, purely to keep the arithmetic tractable. The mechanics are identical regardless of window length. 3 quick facts worth holding on to. Bandwidth is a direct, visual measure of volatility. No other calculation required. You can simply look at how far apart the lines are. Under K equals 2, roughly 95% of closes fall within the bands. Assuming something close to a normal distribution, a number we'll revisit and stress test in the advanced module. And there are 3 distinct ways to read the bands in motion. A squeeze is when the bands pull tight together, meaning volatility has dropped to unusually low levels, often a precursor to a sharp directional move. An expansion is when the bands stretch apart, meaning volatility is rising, usually alongside a strong directional move already underway. And walking the band is when price repeatedly touches or rides the upper or lower band during a strong trend. On its own, that is not automatically a reversal signal, a point we'll return to when we cover limitations. Let's walk through the mechanics with concrete numbers. Bollinger Bands consist of 3 lines. The middle band, a simple moving average, typically the 20-day. The upper band, that SMA plus 2 times the standard deviation. And the lower band, the SMA minus 2 times the standard deviation. The bands expand when volatility is high and contract when volatility is low. That single sentence is the whole indicator. Now let's turn the mechanics into judgment using 4 reading rules. First, price touching the bands. Above the upper band suggests the stock is overbought and price may pull back. Below the lower band suggests oversold and price may bounce back. Notice the careful wording, may, not will. Second, the Bollinger squeeze. Bands contracting signal low volatility and a breakout expected soon. Bands expanding signal high volatility and a strong trend already present. Third, Bollinger breakouts. Price closing above the upper band suggests a strong bullish breakout. Price closing below the lower band suggests a strong bearish breakdown. And fourth, the mean reversion red. Price usually returns to the middle band after hitting either the upper or lower band, which is exactly why traders use the middle band itself as a natural, dynamic target or trailing reference. For those of you comfortable with R, here's the fastest way to reproduce everything we just calculated by hand. using the QuantMod package. You load the library, pull a symbol like NVIDIA over the trailing year with get symbols, plot the chart with chart series, and indicator layer on top with a single code line call. Few lines of code recreate the entire 14-period indicators calculation we just walked through manually. The point of doing it by hand first is that now you actually understand what that one function call is computing under the hood, rather than treating it as a black box. What you're watching now is a live, monthly updating build of Bollinger Bands on real metadata. One new month of trading added to the chart each time it advances, so the price line and the band envelope both grow in front of you rather than sitting still. Two panels, always in sync. Up top, price threading through its upper and lower band, with a tight dashed line marking the stock's own historically narrow 20% bandwidth level. Underneath, percent bandwidth itself, upper minus lower divided by middle times 100, plotted as a single line so you can watch volatility contract and expand without eyeballing the raw bandwidth. Here's what to actually watch for as the months roll forward, since the specific reading you land on will depend entirely on when you're watching this. Every time that lower percent BW line dips down and touches or crosses that dash tight band threshold, the bands above have pulled in tight. A squeeze has formed. Watch what happens in the months immediately after. More often than not, price breaks decisively out of that narrow channel and the bands stretch back apart, which is the expansion half of the cycle. The subtitle updates every month to tell you exactly where things stand, whether a fresh squeeze has just formed, whether a breakout is resolving, or whether bands are simply sitting at a normal width with nothing unusual happening. That last state is common, and it's a legitimate, useful reading in its own right. Bollinger Bands, like every tool in this course, don't owe you a fresh signal every single month. Now let's convert band position into judgment. When price touches the upper band, it's trading at the top of its recent range. That's strong, but not automatically overbought. When price touches the lower band, it's trading at the bottom of its recent range. That's weak, but not automatically oversold. And when the bands are narrowing, that's a squeeze. Volatility is compressing, and a large move in either direction often follows. In terms of real-world use, Bollinger Bands shine in three places: spotting squeeze setups ahead of a potential breakout, sizing stops and targets relative to the market's current volatility, rather than an arbitrary fixed dollar amount, and judging whether a move is genuinely stretched relative to the stock's own recent range. But be honest about the limitations, too. Bands are not a direction signal. They show you range, not which way a breakout will resolve. A tight squeeze can just as easily break down as it can break up. Bands don't predict. They describe recent volatility, and the middle band underneath it all is still a lagging, simple moving average. And watch for walking the band confusion. In strong trends, price can ride the upper or lower band for an extended stretch, and that alone is never, by itself, a reversal signal. Part 2 of today's session, ADX and CCI. Two more ways of reading how stretched a market has become, each measuring a genuinely different dimension of that question. ADX tells you how strong the current trend is, independent of its direction. CCI tells you how far current price has strayed from its own recent average. Together with Bollinger Bands, they give you three separate confidence checks on any trade idea. Before we build either formula, we need new data. Both of these tools require the daily high and low, not just the close, because they measure range and directional movement directly. Here, just ahead. The average directional index measures how strong a trend is, regardless of direction. A rising ADX means the trend, whether up or down, has real conviction. A low ADX means the market is essentially directionless. Here's the formula in simplified form. Positive DI and negative DI equal 100 times the average positive or negative directional movement, divided by the average true range. DX equals 100 times the absolute difference between positive DI and negative DI, divided by their sum. And ADX itself is simply an in-period average of DX. Directional movement, or DM, and true range, or TR, are both derived from the daily high, low, and close. The standard look-back is 14 periods. For today's tractable hand calculation, we'll use 5. Here's how to read the ADX scale. Below 20 means a weak or absent trend. 20 to 40 means a developing or moderate trend, and above 40 means a strong trend, with the actual direction coming from whichever positive or negative DI is on top. Remember, ADX by itself never tells you up or down, only how convicted the current move is. Let's walk the ADX calculation step by step, starting with its two raw building blocks. Step 1. Calculate directional movement. Positive DM equals current high minus previous high. Counted only if positive, otherwise zero. Negative DM equals previous low minus current low. Counted only if positive, otherwise zero. Step 2. Compute true range as the largest of three quantities. Current high minus current low, the absolute value of current high minus previous close, or the absolute value of current low minus previous close. Working through a 5-day illustration with highs of 105, 107, 110, 111, 113, and matching lows and closes. Day 2 produces a positive DM of 2 and a negative DM of 1, with a true range of 6. Day 3, positive DM of 3, negative DM of 0, true range of 9. Day 4, positive DM of 1, negative DM of 1, true range of 7. Day 5, positive DM of 2, negative DM of 1, true range of 8. Notice the pattern. Positive DM captures fresh strength in the highs. Negative DM captures fresh weakness in the lows. And true range simply captures the day's genuine trading range once gaps are accounted for. With those two building blocks in hand, we're ready for the next step, turning raw DM and TR into the DI, DX, and ADX readings themselves. Continuing from the DM and true range figures we just built. Step 3. Compute smooth positive DI and negative DI using 14-period smoothing. For this illustration, we'll assume positive DI equals 20 and negative DI equals 15. Step 4. Compute DX as the absolute difference between those two, divided by their sum, times 100. That's the absolute value of 20 minus 15, divided by 20 plus 15, equal to 5 over 35, times 100, which is 14.3. Step 5. ADX itself is a 14-period smoothed average of DX. For this illustration, assume that smoothing produces an ADX of 25. A more granular strength guide refines the earlier scale. Below 20 is a weak, sideways market. 20 to 40 is a moderate trend gaining strength. 40 to 60 is a strong trend you can act on with confidence. And above 60 signals a very strong trend, potentially even an overextended one. And for crossovers, positive DI above negative DI, with ADX rising is a strong uptrend, a buy-side signal. Negative DI above positive DI, with ADX rising is a strong downtrend, a sell-side signal. And ADX falling, regardless of which DI is on top, means the trend is weakening. Time to tighten up or step aside. For those of you comfortable with R, here's the fastest way to reproduce everything we just calculated by hand, using the QuantMod package. You load the library, pull a symbol like NVIDIA over the trailing year with get symbols, plot the chart with chart series, an indicator layer on top with a single code line call. Few lines of code recreate the entire 14-period indicators calculation we just walked through manually. The point of doing it by hand first is that now you actually understand what that one function call is computing under the hood, rather than treating it as a black box. What's playing now is a live, monthly updating build of ADX put to work as a genuine signal filter on real metadata, layered alongside MACD from day 2. 3 panels always move together as each new month is added. Price runs across the top. Max line, signal, and histograms sit in the middle panel, with small triangle markers flagging each MACD crossover as it occurs. And ADX, with its positive and negative DI lines, sits at the bottom, with dashed reference lines at 24 filter and 25 for confirm. Here's the discipline to watch for as the video advances, month by month. Every time an MACD crossover triangle appears in the middle panel, immediately check where the white ADX line sits underneath it at that same moment. If ADX is below the 20 filter line, you'll often see the crossover get explicitly labeled filtered. The chart is telling you trend strength wasn't there to back up momentum signal, so it's discounted. If ADX is climbing through or beyond the 25 confirm line at the same moment, The crossover instead gets treated as backed by real conviction. Some months will show a fresh, filtered, or confirmed crossover. Many months will show neither, simply because MACD stayed quiet or ADX sat in between the two lines. Either way, the lesson is the same one from part 2 of today's lecture. ADX never generates its own buy or sell call here. Its entire job is deciding whether another indicator's signal has earned your attention. Turning ADX into judgment. ADX rising above roughly 25 to 40 means the trend is gaining conviction, whichever direction positive or negative DI is pointing. ADX falling below 20 means the trend is weakening, or the market is entering a genuine range. And positive DI sitting above negative DI means the directional bias is up. The reverse means the bias is down. In real-world use, ADX excels at 3 jobs: filtering out trend-following signals, like the MACD crossovers from day 1 and day 2, when ADX itself is low, confirming that a breakout actually has real conviction behind it, and helping you decide, moment to moment, whether to reach for trend tools or range tools. But hold the limitations firmly in mind. ADX gives no direction on its own. It must always be paired with positive and negative DI, or with a trend tool like the SMA or EMA from day 1. It lags at turning points because it's a smoothed average of an average, which makes it structurally slow to reflect a fresh change in trend. And in genuinely choppy, sideways markets, ADX can whipsaw around that 20 to 25 zone with very little useful signal inside the noise. The Commodity Channel Index measures how far the current typical price has strayed from its recent average, scaled by how much it usually strays. Despite the name, it works on any sufficiently liquid instrument, not just commodities. Here's the formula. Typical price, or TP, equals high plus low plus close divided by 3. CCI equals TP minus the end-period simple moving average of TP, divided by 0.015 times the mean deviation. Mean deviation is the average absolute distance of each TP in the window from that same moving average. The standard look-back is 20 periods. Today's hand-worked example uses 5, for the same tractability reason as always. 3 quick facts. CCI is technically unbounded, but that 0.015 constant is specifically calibrated to scale most readings into a rough plus or minus 100 band. A reading above plus 100 or below minus 100 marks a statistically unusual extreme. And here are the 3 reference zones. Above plus 100 signals a strong uptrend or overbought condition. Typical price is unusually far above its recent average on the upside. Between minus 100 and plus 100 is the normal range. Typical price sits within its usual recent dispersion. And below minus 100 signals a strong downtrend or oversold condition. Typical price is unusually far below its recent average on the downside. Let's hand calculate CCI on real numbers. Step 1. Compute typical price for each day as high plus low plus close, divided by 3. Using a stock's 5-day high-low close data, the typical prices come out to 102.33, 104.67, 107.67, 108.67, and 110.33 across the 5 days. Step 2. Compute the simple moving average of typical price over the chosen look-back. For a standard 20-day CCI, that's a 20-period average. For this illustration, assume that SMA of TP equals 108. Step 3. Compute the mean deviation, the average of the absolute deviations of each TP from that SMA. Assume that comes out to 3. Step 4. Plug everything into the formula. CCI equals 110.33 minus 108 divided by 0.015 times 3. That's 2.33 divided by 0.045, which equals 51.78. That reading, 51.78, sits comfortably inside the normal range between minus 100 and plus 100. It tells us typical price is running a bit above its recent average, but not yet at a statistically extreme level. Remember the 2 trading rules that frame this number. CCI above plus 100 is read as overbought, a possible sell signal. CCI below minus 100 is read as oversold, a possible buy signal. This is a live, monthly updating build of CCI on real metadata, with two panels moving together as each new month is added. Price sits on top. CCI itself sits underneath, with dashed reference lines at plus and minus 100 marking the extreme thresholds. The distinguishing feature of this particular chart is the shaded vertical bands. Every time CCI pushes beyond plus 100, you'll see a green band appear behind the price line marking that bullish extreme zone. Every time it pushes below minus 100, a red band marks the bearish extreme instead. Watch how the subtitle updates each time one of those zones resolves. It will report exactly how many trading days the extreme lasted, where CCI peaked or troughed inside that zone, and how much typical price actually moved while the zone stayed open. That's the entire teaching point of this chart in motion. CCI cycles through overbought and oversold far more rapidly than a slower trend tool would, and watching the shaded bands appear and resolve, month after month, is a direct visual record of exactly how often and how forcefully that cycling actually happens on a real, liquid name. In a month where no new extreme is fired, the chart will simply say so. That's CCI confirming that current conditions are unremarkable, which is itself a legitimate, useful reading. Let's put all three of today's tools side by side, because seeing their differences explicitly sharpens your understanding of each one individually. On what they answer, Bollinger Bands ask how wide the range is. ADX asks how strong the trend is. CCI asks how stretch price is right now. On construction, Bollinger Bands are built from the SMA plus or minus standard deviation. ADX is built from directional movement and true range. CCI is built from typical price against its own mean deviation. On scale, Bollinger Bands produce price level bands that are unbounded. ADX runs 0 to 100 and is direction agnostic. CCI is unbounded and centered on 0. On best signal, Bollinger Bands shine at squeeze to breakout setups. ADX shines at filtering out weak trend signals. CCI shines at cyclical extremes beyond plus or minus 100. Here's the rule of thumb to carry forward. None of these three tools tells you which way price will go. They tell you how wide the range is, how strong the current move is, and how far price has stretched from normal. Three different confidence checks on a trade idea, not three separate trade ideas competing with each other. Our strategy spotlight for today, combining a Bollinger squeeze with ADX confirmation. On its own, a squeeze only tells you a move is coming, not which direction, and not whether it will carry real conviction. Step 1. Spot the squeeze. In our worked example, Bollinger Band width shrank from 10.4 on day 5 to 7.4 on day 9. Volatility compressing to its tightest point across the entire window. Step 2. Confirm with ADX. Our ADX reading of 58.2, well above the 40 strong trend threshold, confirms real directional conviction is already building behind the breakout that follows on day 10. Put together, bands expanding, ADX rising, and price pushing toward the upper band all at once make a materially higher confidence signal than any single tool acting alone. But hold the trader's caution firmly in mind. A squeeze can also resolve into a false breakout that reverses quickly. Waiting for ADX to confirm reduces that risk. It never eliminates it. Position sizing and stops still matter on every single trade, regardless of how many indicators agree. We're now entering the advanced module. This is where today's session goes further than a typical introductory treatment of Bollinger Bands, ADX, and CCI. 6 things are on the agenda. First, we standardize the eyeballed Bollinger squeeze into a proper, scale-free statistic, the bandwidth ratio and its z-score. Second, we formally derive what CCI's plus or minus 100 threshold actually implies under an explicit distributional assumption. Third, we build a multi-indicator volatility regime confluence matrix, combining all 3 of today's tools into named market regimes. Fourth, an honest look at the statistical caveats underneath all of this: stationarity, autocorrelation, sample size, and overfitting risk. Fifth, a strategy spotlight on the volatility regime breakout, a fully rules-based extension of Part 1 Squeeze plus ADX idea. And sixth, we bridge all 3 tools back to Stan Weinstein's 4-stage framework from day 1. Let's start with the bandwidth ratio. Here's the specific problem the bandwidth ratio solves. Raw bandwidth, upper minus lower, scales with price level. So a $9 width means something completely different for a $110 stock than for an $1,100 stock. It's also not comparable across time as a stock re-rates higher or lower. Dividing by the middle band fixes both problems at once. The formula, bandwidth ratio at time t equals upper minus lower divided by the middle band, which simplifies to 2 times k times sigma divided by the SMA. The z-score of that ratio, z sub BWR, equals the ratio itself minus its rolling mean, divided by its rolling standard deviation, both computed over an M-period look-back, where M is independent of N, the SMA length used inside the bands themselves. The standardized squeeze definition becomes precise. A squeeze is Z sub BWR falling below negative 1.5, sustained for several consecutive sessions, over that M-period look-back window. Here's what this buys you over the eyeball squeeze from part 1. Cross-asset comparability. So, a $9 stock and a $900 stock can use the exact same threshold, a single pre-committed rule instead of subjective the bands look tight judgment call, and a parameter, that negative 1.5, that can actually be back-tested and calibrated rather than simply eyeballed off a chart. One important note on that constant. Negative 1.5 is a convention, not a derived critical value. The caveat slide just ahead is explicit about the assumptions behind thresholds like this one. Let's standardize the same squeeze from ABC Limited that we used in Part 1 Strategy Spotlight, using the same day's 5 through 10 window and band data. Bandwidth runs 10.4, 9.2, 10.6, 8.6, 7.4, 9.2 across those 6 days. Converting each to a bandwidth ratio percentage gives 10.1%, 8.83%, 10.04%, 7.99%, 6.81%, and 8.38%. Standardizing those against this 6-day window's own sample mean and standard deviation produces z-scores of plus 1.12, plus 0.11, plus 1.07, minus 0.56, minus 1.49, and minus 0.25. Look closely at day 9. Z sub BWR reaches minus 1.49, close to, but not quite past, our negative 1.5 threshold. That's a genuinely borderline case, and it's exactly the kind of edge case a fixed statistical rule is supposed to resolve consistently, rather than leaving it to subjective judgment. One important caveat before we move on. This 6-day window is for illustrating the mechanics only. With M equal to 6, the mean and standard deviation are estimated from just 5 degrees of freedom, and they are highly unstable. A live system should use M of roughly 60 to 120 sessions for a statistically meaningful rolling estimate. We'll return to exactly this point in the caveat slide ahead. Lambert's 0.015 constant inside the CCI formula is usually quoted as making about 70 to 80% of values fall within plus or minus 100. Let's actually derive that claim rather than take it on faith. CCI uses mean absolute deviation, not standard deviation. CCI equals TP minus its SMA divided by 0.015 times the mean absolute deviation. For a normal distribution, mean absolute deviation relates to standard deviation by a fixed constant. MAD is approximately sigma times the square root of 2 over pi, which comes out to roughly 0.7979 sigma. Substituting that relationship back into the CCI formula shows that CCI is approximately 83.5 times the standard z-score of TP relative to its mean. In other words, CCI is an implicit z-score, but only under an explicit assumption of normality. Here's the coverage table that falls out of that derivation. A CCI level of plus or minus 100 implies AZ of roughly 1.20, which under a normal distribution covers about 77% of outcomes. Plus or minus 150 implies AZ of about 1.80, covering roughly 93%. And plus or minus 200 implies AZ near 2.39, covering about 98.3%. That matches the commonly cited 70 to 80% inside plus or minus 100 rule of thumb almost exactly. But now you can see precisely where that number comes from and precisely where it can break. And it does break. Real typical price deviations are fat-tailed, not normal. A finding that traces back to Mandelbrot and Fama's work on market returns. So extreme CCI readings occur more often in practice than this table implies. Treat these percentages as an idealized benchmark, not a literal probability. Before we formalize the regime matrix, let's watch its central idea play out live. This is a monthly updating build of the same Bollinger squeeze plus ADX confirmation logic from our Part 1 strategy spotlight, now run continuously on real metadata across 3 stacked panels. Price with its bands on top, percent bandwidth in the middle, and ADX with its DI lines at the bottom, with dashed reference lines at 25 for confirm and 44 strong trend. Here's exactly what to track as the months advance. Watch the percent BW panel for a genuine squeeze, the line dropping down toward this stock's own tight band threshold. Then, in the same stretch of time, watch the ADX panel underneath it. If ADX is climbing through or beyond that 25 line as price pushes out of the squeeze, you're watching a confirmed setup, exactly the combination the strategy spotlight described. If instead ADX stays flat below 25 while the bands widen, that's an unconfirmed expansion, volatility moving without real trend conviction behind it, a materially weaker setup. The subtitle each month reports plainly whether a new squeeze, breakout, or ADX confirmation actually occurred. And just as often, it will report that none of the 3 happened, which is simply the market sitting in a normal, unremarkable state. Watching this cycle repeat across many months is the fastest way to build real pattern recognition for how rare a fully confirmed squeeze breakout actually is, compared to how often the bands alone look tempting on their own. Now let's combine all 3 tools into a single, structured regime matrix, because no single tool alone tells you which way price will go, but combined, they classify the current market regime, and each regime implies a different posture rather than a mechanical trading rule. When Z sub BWR is below negative 1.5, ADX is below 20, and CCI sits between minus and plus 100, that's a pre-breakout consolidation regime. The posture is to reduce size, since there's no directional bias yet. When bandwidth ratio is expanding, ADX is rising above 25 with positive DI leading, and CCI is above plus 100. That's a confirmed bullish breakout. The posture is trend following long, trailing the middle band. The mirror image, expanding with, rising ADX with negative DI leading, and CCI below minus 100, is a confirmed bearish breakdown with the equivalent short side posture. When Z sub BWR is high, above 1.5, ADX is fading, and CCI has pushed past plus 200. That's a bullish climax or exhaustion regime. Tighten stops on longs and take no new entries. Its mirror, high Z sub BWR, fading ADX, CCI below negative 200, is bearish climax or capitulation, where the posture shifts to covering shorts and watching for a base to form. And when bandwidth ratio is narrowing, ADX is low and choppy, and CCI is simply oscillating within plus or minus 100. That's a range-bound regime corresponding to stage 1 or stage 3 from day 1. Avoid trend systems here, and only fade genuine extremes. Notice that the 2 climax rows mirror each other by construction. That symmetry is a useful sanity check in itself. A well-specified regime rule should treat bullish and bearish extremes identically, just with the signs flipped. Every threshold on the last several slides rests on assumptions, and a rigorous analyst names them before trusting the number. 5 caveats help front of mind. Non-stationarity, rolling mean, and standard deviation calculations assume local stability within the window, but real volatility clusters, what statisticians call arch and GRCH effects, meaning today's variance predicts tomorrow's, which violates the independence assumption a simple z-score implicitly leans on. Fat tails, not normal. Return and indicator distributions show excess kurtosis relative to a Gaussian curve, so the CCI coverage table from 2 slides back is an idealized benchmark. Extreme readings happen more often than a normal model predicts. Autocorrelation, Daily observations are serially correlated, which means the effective sample size behind any rolling estimate is smaller than the raw count of days suggests. Your estimates are less precise than they look on paper. Small sample instability. Short look backs, like the M equals 6 we used purely to illustrate the mechanics, give unstable mean and standard deviation estimates. Longer windows of roughly 60 to 120 sessions stabilize them, at the cost of reacting more slowly to a genuine regime change. A real bias variance trade-off, not a free lunch. In threshold overfitting. Picking negative 1.5 or 25 or plus or minus 100 simply because they worked on one particular dataset is data snooping. Any threshold you intend to trade on real capital needs out of sample or walk-forward validation, not just an in-sample fit. Let's turn all of this into a concrete, rules-based strategy. The volatility regime breakout, a 3-filter extension of Part 1's Bollinger plus ADX spotlight, now with a statistically defined squeeze and a cyclical trigger layered on top. Filter 1, the squeeze. Z sub BWR below negative 1.5 for at least 5 consecutive sessions on an M of roughly 60 to 120 days, a statistically extreme compression, not an eyeball call. Filter 2, trend acceleration. ADX crosses above 20 with positive DI above negative DI for the long case. Notice we use 20 here, not 25, a deliberately earlier and more sensitive trigger traded off against a higher rate of false signals. Filter 3, the cyclical trigger. CCI crosses above plus 100, confirming that typical price has moved from neutral into a statistically extreme zone. Roughly a Z above 1.2, straight out of the CCI derivation 2 slides back. The execution rules. Enter on a close above the upper band with all 3 filters satisfied. Place your stop at the trailing middle band, or alternatively at parabolic SAR, which we'll cover on day 5, and exit when ADX turns down from above 40, or negative DI crosses above positive DI, or CCI reverts below plus 100, while Z sub BWR spikes sharply positive. That last condition is the climax signature straight from our regime matrix. And the trader's caution stands unchanged from everything else today. Thresholds tuned on one data set are prone to overfitting. Validate out of sample before trusting this, or any rules set, with real capital. Position sizing and stops still matter regardless. Let's bridge directly back to day 1. Recall Stan Weinstein's 4-stage framework: Stage 1 basing, Stage 2 advancing, Stage 3 topping, Stage 4 declining. Here is the Z sub BWR, ADX, and CCI signature at each stage and at each transition between them. In Stage 1, basing, Z sub BWR trends negative as a squeeze forms. ADX sits below 20 and non-trending, and CCI oscillates near 0 within plus or minus 100. At the transition from Stage 1 into Stage 2, Z sub BWR crosses back above 0 from below negative 1. ADX crosses above 25 and begins rising, and CCI breaks above plus 100. In Stage 2, advancing, Z sub BWR is positive and expanding. ADX holds above 25 and often sustains above 40, and CCI stays repeatedly pinned above plus 100. At the transition into Stage 3, Z sub BWR shows a possible late spike followed by a rollover. ADX rolls over from above 40, and CCI shows bearish divergence against price. In Stage 3, topping, Z sub BWR is variable with no clear trend. ADX is falling and choppy, and CCI swings erratically across the plus or minus 100 band. At the transition into Stage 4, Z sub BWR re-expands to the downside. ADX rises again with negative DI dominant, and CCI breaks below negative 100. In Stage 4, declining, Z sub BWR is positive and expanding on the downside. ADX stays elevated with negative DI dominant, and CCI stays pinned below negative 100. And on the final transition, back from Stage 4 into Stage 1, Z sub BWR compresses as a squeeze reforms. ADX falls back below 20, and CCI stabilizes near 0. The gold highlighted transition rows are where 2 or 3 signatures should shift together. And that convergence, not any single reading in isolation, is what separates a genuine regime change from ordinary noise. It's the exact same discipline as day 1's Qsum bridge and day 2's momentum bridge, now extended to volatility. What you're watching now is a live, monthly updating build of that same 4-stage framework applied to real metadata. 4 stack panels, all growing together as each new month is added. Price sits on top, shaded by stage as it's identified. Gray for basing, green for advancing, brown for topping, red for declining. Underneath, Z sub, BWR, ADX with its DI lines, and CCI each get their own panel with the same reference lines you've seen throughout today. The -1 squeeze line, the 20-25-40 ADX lines, and CCI's plus or minus 100 band. Notice the legend at the top only lists the stages that have actually appeared so far in the video. It grows as the shading grows, which is itself a small, honest signal that nothing here is pre-scripted. Here's the discipline to watch for as the months advance. A genuine stage transition is marked by the shading flipping color, and the strongest, most trustworthy flips are the ones where 2 or 3 of the panels underneath shift in agreement at roughly the same time. Z sub BWR crossing its squeeze line, ADX crossing 25, and CCI breaking its plus or minus 100 band, all clustering together. Most months, the subtitle will simply report no stage flip, with the current stage named explicitly. And that's not a quiet month wasted. It's confirmation that the convergence bar for calling a genuine regime change hasn't been met yet. That discipline, waiting for agreement across panels rather than reacting to any single line, is the entire point of watching this chart evolve in real time rather than as a single static snapshot. Before we close out today, 6 questions for you to work through in your own notes. We'll review them together at the start of day 4. Question 1. Bollinger Band width has been shrinking for a week. What does this suggest is coming? And just as importantly, what does it not tell you? Question 2. A stock has an ADX of 15. Should you trust a fresh MCD crossover signal on it as strongly as one on a stock with an ADX of 45? Question 3. What does a CCI reading of plus 140 suggest about the current typical price relative to its recent average? Question 4. Why does combining a Bollinger squeeze with a rising ADX produce a higher confidence signal than either indicator alone? Question 5. Why is CCI? Let's consolidate everything from today into 9 takeaways. 1. Volatility measures how wide price's range has become, a different question entirely from trend, day 1's focus, or momentum, day 2's focus. 2. Bollinger Bands equal the SMA plus or minus K times standard deviation. A squeeze, meaning narrowing bands, often precedes a sharp move. 3. ADX measures trend strength independent of direction, built from positive and negative directional movement and true range. Above 40 signals a strong trend. 4. Positive DI versus negative DI gives you direction. ADX itself only tells you how convicted that direction is. 5. CCI equals typical price minus its SMA divided by 0.015 times mean deviation. Beyond plus or minus 100 marks a statistically unusual extreme. 6. Combine the tools. A Bollinger squeeze confirmed by a rising ADX is a materially stronger setup than either signal acting alone. 7. From the advanced module. The bandwidth ratio standardizes bandwidth into a genuine z-score, where z sub BWR below -1.5 defines a statistical squeeze, making the signal comparable across completely different assets. 8. Also advanced. CCI's plus or minus 100 rule derives from mean absolute deviation being approximately 0.7979 sigma under normality. But real markets are fat-tailed, so treat that rule as a benchmark, never a guarantee. And 9. Mapping Z sub BWR, ADX and DI, and CCI onto Weinstein's 4 stages give you 3 independent confirmations of the same underlying regime shift. Hold on to all 9 of these. They're the foundation everything in today's advanced module was built on top of. Looking ahead to day 4. Momentum oscillators 2, covering the sham momentum oscillator, rate of change, Williams percent are the stochastic momentum index and the detrended price oscillator. CMO and ROC give us two more ways to measure the pace of price change, each with a slightly different formula and use case than the RSI you built on day 2. Williams percent are an semi-refined, that same overbought oversold concept, with different scaling and different sensitivity. And DPO, the detrended price oscillator, strips trend out entirely to isolate the shorter cycles hiding underneath it. Here's why day 4 follows logically from today. Momentum, which we build on day 2, tells you speed. Volatility, which we just built today, tells you range. And a second, deeper pass on momentum tomorrow will sharpen exactly how you time entries within whatever regime today's tools tell you you're actually in. As a structural reminder, days 5 and 6 will cover volume and adaptive trend tools, and finally a strategy and fundamental crossover capstone, steadily building toward the complete indicator toolkit this entire course promises. That completes day 3. You now know how to compute Bollinger Bands, ADX and CCI entirely by hand. Read what each one is actually telling you about a stock's volatility and trend strength, and, going further than most introductory courses, standardize the Bollinger Squeeze into a real statistical z-score, derive exactly what CCI's thresholds imply under a distributional assumption, and use all 3 tools as a live confirmation layer on top of day 1 stage analysis framework. Take some time before day 4 to sit with today's knowledge check questions and come back ready for momentum oscillators 2, CMO, ROC, Williams percent R, SMI, and DPO. Thank you, and see you in day 4. This has been Dreamlit Equity Research. A reminder that all content in this course is educational only and does not constitute investment advice from an SEC-registered advisory service.